What's up, guys? Jay Martin here, and my guest today is Gareth Soloway, the Chief Market Strategist at InTheMoneyStocks.com. I've had Gareth on before. He's a bit of a crowd favorite. I certainly love talking to him, and we went all over the map in this conversation, but what I love about Gareth is that he's very technical. And he shares some charts with us today and walks through a lot of what he's seeing in the market and how that's impacting his actions, how he's setting up his portfolio. But I'm not a super technical investor. I watch sentiment, I watch macro trends, and I invest in entrepreneurs, very much a people-driven investor. So Gareth's perspective is super, super valuable to me, and I always learn a ton when I have him on the show. So I hope you do as well. This conversation was super fun. Now, 3 things before we jump into today's interview. Number 1, if you enjoy my content, sign up for my newsletter. It's free. I publish every Friday. The link to subscribe is right beneath this video in that pinned comment. Number 2, when I started this YouTube channel, I never anticipated generating ad revenue. Coincidentally, I do now, which is awesome. And so what I've decided to do with this cash is donate it to an organization that is super close to my heart. They are called Zero Ceiling. They are committed to ending youth homelessness, and the way that they do this is by providing supportive housing, employment, life skills, and outdoor recreation for homeless youth. Now, I am somebody who is massively transformed by my experiences in wild places and exposure to the natural world. And so they're taking this gift and sharing it with urban youth who may never get that opportunity otherwise. It's a rad organization. Please check them out. Number 3, if you would rather listen to my content rather than watch it, you can now find us wherever you listen to your podcasts. Just search The Jay Martin Show. Okay, here's Gareth Soloway. Enjoy. What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome. What's up, guys? Jay Martin here, and I'm joined right now by Gareth Soloway, the Chief Market Strategist at InTheMoneyStocks.com. Gareth, it's good to see you again.
Hey, thanks for having me again, Jay.
Yeah, my pleasure. I'm stoked to have you back, and I've got a web of directions I want to take this conversation. Where I'll start maybe is if anybody have not seen our first interview or have seen you anywhere else, give us the highlight reel. What is In the Money Stocks, and how do you spend your day?
Oh, wow. The day is spent looking at charts. Again, technical analysis is really my bread and butter for finding trading opportunities. I love technicals because a chart is a chart. Doesn't matter if it's crypto or a stock or an ETF or Forex. Or commodities or anything, it all follows the rules of charts generally, right? And again, it's always important to remind people that when you analyze charts, it's about probabilities. So you want to put the probabilities in your favor, and then you decide if you want to take that trading opportunity. So no trade is 100%, but by getting the probabilities in your favor, you then become the house as the casino versus a gambler in the casino. In the Money Stocks does stocks, commodities, pretty much everything. And, been doing it since 2007 as the company, and it's been a fun ride for sure.
Okay, I love that. So where are the probabilities in our favor today?
Well, probabilities right now are definitely, at least for the stock market, pointing to some sort of correction, which, believe it or not, goes counter to what everyone's saying, right? I mean, if you think about what everyone's saying, everyone says, oh, this market can never drop. It can never fall to the downside. But actually, there's a lot of breaks on the charts that are now showing themselves as trend lines and so forth. So I don't know if you can give me the ability to share my screen, but I'd love to show the viewers there exactly what we're talking about here.
Yeah, you're good to go there.
Awesome. Fantastic. So here you have, this is the Bitcoin chart, but we'll flip it over to the SPY first. And I think this next chart is just so enlightening. So what you can see here is that this upsloping trend line goes all the way back to March of 2020. So that was the crypto low. I mean, the COVID low in the charts. And notice how it kind of initially barely touches here, doesn't really touch. Then it kisses it, then it hits it a little bit more, then it pierces it by a wider margin. And one of the things that struck me, and I just kind of put this together a week ago, so it just shows you that no one's perfect, no one sees everything, but look at initially how long it took for this chart to even come close to that trend line and how far away it got. So this was the biggest distance from the line and the furthest distance. And then notice how the next time here, it's still away from the line, but it's shorter and it's less of a height. And then it gets smaller and smaller and smaller. And here it touches the line, touches it again, pierces by a wider margin. And then what you see here is it got below 2 days in a row, which was the first time that happened. And then it came back, and notice how it's not able to fully get above this trend line. And what that basically tells you in layman's terms is that that chart very visibly is weakening, right? Every bounce is less of a bounce. It's staying away from that trend line to the point where now it's not even able to get above that trend line. So things like that catch my eye as an investor, and it starts to shift your probabilities. We know the markets are extended. We know valuations are extended. But now we can see it in the charts, how it's actually playing out. Now, it doesn't guarantee that tomorrow the markets are going to collapse or anything like that, but it's giving you the probabilities that something is coming on the horizon. Now, if we look at the QQQ, the NASDAQ 100, notice how there's a beautiful channel that's developed here. And actually, this channel goes back to 2019. And notice how when you hit this high pivot, you had a pretty nice sell-off. Then you hit it again, another nice sell-off to the low end of that channel. It got close, pulled back. And now look at how just recently you touched this blue line one more time. And again, just going by history, it tells us that the odds favor. It doesn't guarantee it, but the odds favor some sort of pullback in the not too distant future. So those are the things that kind of are catching my eye here. It has me slowly accumulating some shorts on the indices and getting ready for some sort of pullback, whether it's 5% or 3% or 10%. It's honestly hard to know, but there should be something in the next week or two that starts ticking to the downside.
Interesting. Okay. Yeah. I was curious how you were positioning yourself, how you're playing that. I'm wondering, Gareth, if you can humanize that trend, the SPY chart you showed us, the trend, the way it's going, what's occurring in the market from a buying and selling standpoint, market participation, retail, institutional, what's occurring? You could speculate if you want to, that's causing this trend to shift.
Yeah, so that's a great question, right? So basically this usually occurs so the biggest bounce with the most volume. If you look at the volume down at the bottom of the screen, notice how heavy the volume was initially on that bounce. And then if you look at the current volume in the markets, it is anemic. It is so light. And what this generally is telling us is that as the market initially started that bounce, there was a lot of institutional buyers. So you had, hedge funds buying, smart institutions accumulating. They were really heavily buying this market. Now, the market still has net buyers, and that's why it's still going up. But you're seeing less and less of that, meaning that it's less institutional and more retail. All right. And again, anytime you see a market that has very, very light volume in it, it tells you that obviously, it's not like the Goldmans, the JPMs, they're not loading the boat here because you'd see heavier volume in the market. So that's another kind of little signal that you have to say, okay, listen, if they're not buyers, net heavy buyers here, is that a caution sign at least? Even if you don't want to sell your longs, is it just a cautionary signal that could tell us something is on the horizon, or maybe the upside is limited at least in this market? So I think that's a good way of looking at it. Every time you get a bounce here, as it's getting smaller and smaller, it tells you that likely institutions are selling more and more into it, which is, again, why the market has so much trouble. Like, even if it was just retail buyers and there was absolutely zero sellers, you'd still see the market going straight to the upside, right? But again, it's getting less and less of a bounce each time, which tells you there are individuals, likely institutions, that are starting to sell this market more aggressively over time.
Yeah, I mean, the quote unquote smart money that I talked to has definitely been de-risking, recently. More and more frequently that comes up in the conversation. This is actually reminiscent of the last time I had you on. We were having a similar conversation, but we were talking about crypto prices, specifically watching the cycle of institutional money come in, inflate the price a little bit, create a bunch of media buzz, retail follows. You get this massive takeoff in price performance.
Yeah. And I think I actually remember that. And we were talking about how the pivot highs were getting less and less, and then you started to make lower lows. And I remember talking about that when we were kind of in that 60 to 65,000 range, how you made the top here. And then finally, here was a low, here was a lower low. And then you made a lower high here. And again, that was a signal that you were kind of on the downshift where you had net more sellers. And then obviously the drop of till 30,000 occurred after that. So that was pretty wild, man.
That was pretty wild. Yeah. And just for reference, that was May 20th. I had you on and you were calling for a drop or a crash in the crypto price. And I think you were saying you're waiting for a crash and you're hoping for 30,000 so you could start buying again. So how did you action this correction, Gareth?
So when that occurred, I actually did buy just north of 30,000. I always like to do that because if my low is 30,000, I don't want to be the guy that puts it right there, and then I miss getting filled by
Sure.
$100 on Bitcoin or something, and you look back and you say, why did I squabble over $100? So I put it a little bit above, and then I think it was that exact day where it bounced back into the 40s, and I actually took my money off the table there because it was such a dramatic bounce there. And honestly, my net expectation was that you were going to kind of chop around and come back in, and that's kind of exactly what you did. And then I started talking in the previous months to the current time about a float up to basically what we would call a retrace to the scene of the crime. So again, for those of you that have followed me on Twitter and so forth, I've been talking about a rally back to about 52.5, maybe as high as 55,000. And really what that is a technical retrace. So here you had this head and shoulder pattern, which played out picture perfect to the 30,000 level. That's why I was making that call when I was on last time. And then basically, oftentimes you'll see this on more charts than not. Price eventually goes back to that same trend line. We call it the scene of the crime. So the crime, essentially, the breakdown occurred at that trend line when it was breached. And somehow price wants to go back there. But when it gets there, it actually has a lot of trouble. There's a lot of resistance right there. And interestingly enough, funny, we're talking about this because today Bitcoin just had a pretty big drop on it and trading now around 47,000. So a pretty big deleveraging event there in Bitcoin.
Okay. And can you speculate what you expect in the crypto market?
Yeah. So
near term.
Yeah, absolutely. So the thought process on Bitcoin should be that you're going to see some chop between this 50 and 40 level. 40 to 41 is going to be a lot of support. Eventually, I do believe it breaks. It goes down to the 30,000 level, which will retest that target from the head and shoulder breakdown that was back in May. You'll get a big bounce there because there's going to be a lot of investors that say, oh, this is the low pivot. This is major support. Ultimately, I actually expect it to go lower to about 18 to 20,000. And this would be a retrace to the 2017 highs on Bitcoin. And that's where I'll be really accumulating. My long-term, again, a lot of people are always like, oh, he's bearish on Bitcoin. He hates Bitcoin. Actually, my long-term view is that you're going to 100,000. Eventually, you're going to 500,000 on it. It's just that you have to wash out this liquidity bubble. And by the way, that goes for everything, including the stock market. There's so much liquidity, so much printing of money that the Fed has done that has just infiltrated the system, including crypto, that it just has to be wiped out and kind of brought back to earth, and kind of a reset has to occur. So that even goes with stocks. I think you need to see at least a 20% correction in the stock market before reality can kind of be functional again and things can start to grind to the upside.
Yeah. Okay. Interesting. So fascinating to get your sentiment on Bitcoin right now. I love your price forecast, by the way. I hope you're right, Gareth. I hope we come back down to 20,000, 18,000. What an opportunity. That's same how I see it,
And what can I just jump into? What's amazing about that is that, I'll say 18 to 20, right? And everyone, and this isn't you, but like just people on Twitter have always said like, oh, I really hope that happens because I want to rebuy. The amazing thing about markets is that when it actually gets there, a lot of people will be too scared to buy. And that's usually the signal that you want to buy. When everyone is so fearful. I mean, you could go back to when Bitcoin was trading at, after 2017 and 18 and even 19, it was at 5,000, 6,000, 7, people were just scared. I mean, I still remember vividly, CNBC actually took the ticker of Bitcoin off their show in the afternoon or even all day. And that was almost like a bottoming signal. Like, okay, now that CNBC is not pumping it, it's now the time to actually accumulate. So just interesting stuff like that.
100%. Now you're making me think. So this morning I was talking to Tavi Costa from Crescat Capital, and I was hitting him up. I was like, where are we finding, where is an asset class that's undervalued right now, right? If I'm sitting on some dry powder and I'm looking to build a position in something that I'm not already holding, right? What is not inflated right now? So, I want to pass this to you because what you just said, right? What are people scared of right now, Gareth? Like, where is that unloved, hated asset class? What is it? Anything strike you?
So over the last 2 to 4 weeks, my biggest trades have come in the China stocks area. And again, that's anytime, and this is a great example of it. I would post up on Twitter and people would be like, oh, China communist regime, it's too risky. And all that hate makes me want to buy it more because that's that same sort of thing when everyone else hates it. And again, you have to look at things logically. If someone says, if a company comes out and says, hey, we're going bankrupt, well, then you don't say, well, everyone hates it because it's going, and you don't buy it. But when you have companies like Alibaba and Baidu that are like best of breed, the champions of China. I mean, China's not going in there to wreck them 100%. I mean, that just isn't smart. It doesn't go with any sort of mentality that makes sense. And so when you get discounts where they're trading at ridiculous discounts, that's exactly where I've been accumulating. I'm still in Alibaba. I'm still in Baidu. We're in the money now on them. Initially, I was out of the money because, generally the way I work is I started accumulating slowly and then they fell more. I bought a little bit more. And overall, my average was a little bit above where the lows are. Now, as the bounces come in, I'm in the money and I just want to let them ride at least for a little bit longer. So I think China stocks still have some upside. Doesn't mean China won't regulate a little bit more, but I think overall the valuations make sense. You have 1.5 billion consumers over there. I mean, that's a lot more than in the US. And then even I think gold a little bit. I mean, gold's had some big runs, although it's pulling back today. But people in general, especially crypto people, are just very dismissive of gold. And to me, it's just the kind of the stable play. It's not going to make you 100% overnight or in a month or so like a cryptocurrency could. But it's the stable play that as you see the printing of money, as you see what the Fed is doing, the government debt just continuing to rise, it makes me feel kind of better sleeping at night to have some gold in my portfolio.
Me too. You know what's funny is well, there's the stigma angle to the gold conversation. I mean, you said it, like the crypto community loves to hate on gold. It's so true. But there's something about it because like I own gold. I own physical gold, coins and bars. I keep them in a safe. I own a lot of gold equities. I also own a lot of crypto. I own real estate, whatever. But if I mention to somebody that I own some physical gold, immediately, probably the next question is, so when did you become a gold bug, or what made you a gold bug? I'm like, okay, I do own gold. Correct. Yes, I also own real estate. Does that make me a real estate bug? I hold cash. Am I a cash bug? No, you'd never ask me that question, right? But because I hold physical bullion right away, I'd love to dive into that. But first, I got to back up because I need to understand what occurred in the China market a little bit better. So I'm a dummy, Gareth. I have not been following that story. Could you explain to me what occurred in the China market, why you think the crash occurred and what's happened since?
Yes, absolutely. So basically, in my opinion, you had the big anniversary in China of the regime, of the communist regime there. And basically, they looked at their big companies. And I truly believe that they've seen what's gone on in the US and they say, listen, we don't want that to happen. And what do I mean by that? I mean, like, you look at a Facebook, you look at a Google, a lot of these companies are standing up to our government. You always hear about regulation from our government, and then somehow it never happens. You hear about all these different things. The government's going to do this, and it just never materializes because these companies have so much power, whether it's social media or these things, or just money to kind of buy politicians with donations, that nothing is ever going to get done. And China sees that and says, hey, listen, we don't want that to occur. So what did they say? Well, before our companies get too massive, let's start putting in regulations to halt that. And again, I don't really blame them per se. You could say, oh, they're communists, they're doing this, they shouldn't be doing this. But again, they want to just make sure that they can maintain and keep some of the issues that the US has had away from their own people. You can argue whether that's good or bad, and then that's fine. But I think that's really where it came from. And then the regulation has been, some of the regulation that would crush the China stocks made no sense to me. Like one of the days I woke up and the Chinese stocks were down 5 or 10%. And the regulation was like, companies can't post fake reviews about their company, or you can't drive fake traffic to your website. And it's like, well, that's actually good. You want transparency. And that's the other side of it. I'm wondering if, part of it is them maintaining control. But remember, the SEC said months ago that if in 3 years these companies don't allow transparency and audits, then they're going to be delisted from US markets. And you got to wonder if China's starting on the process of really making it more transparent. I don't think China cares so much about the listings in the US, but at some point, China wants to open up its markets to billions, if not trillions of money flowing in from outside sources. And that's just going to be the hugest boom for the Chinese economy. So there's a lot of different things here. I think the market took it poorly because honestly, if a company can drive fake traffic to their website, they can charge more for advertising. So yeah, it's going to hurt advertising dollars. Another thing they said was, kids can't play more video games than this many hours a week.
That was interesting.
Another one was the Chinese education stocks. The core curriculum had to be nonprofit. Yes, it's the government coming in, but at the same time, it's arguable whether it's really a negative in the longer term or a positive, I think. So anyways, I mean, that's the long story short that kind of crushed the Chinese stocks. For me, again, I just remind myself when the panic was hitting, all right, how many people, how many consumers in that country, will these companies figure out a way to survive and thrive? And the answer is yes and yes and yes. So
yeah, anyways. that's really interesting. Yeah, the video game restrictions struck me. I saw that headline, and it's quite restrictive. It's something like 1 hour on weekends and holidays per day.
Yeah, I think it was like 3 hours a week total, I heard. Yeah.
Yeah. Okay.
And it is, I mean, considering you have some kids in the US playing probably 10 hours a day or 6 hours a day, it is really restricting for sure. So
hard for us to wrap, or anybody, I guess, if you enjoy freedom of choice and just libertarian principles, it's easy to hate on that. You can understand the rationale at the same time, right? Like this is,
yeah.
So, okay. So back to that then, what's occurring when China makes these announcements, that correct their market, et cetera? Do you think they're posturing in a way to send a message to Chinese companies to say, we'll flex when we need to? Like, remember when Jack Ma disappeared for like 3 months, right?
Yeah.
It was like, where did this guy go? Right. It was a pretty big message, right?
Yeah.
And so is it a flex to Chinese companies to say, we're still in power, we'll always be in power, and if we need to flex, we will? Or could it also be a message to the world saying, we're going to be the steward when we need to be? And if that means playing bad guy to our own companies, we're willing to do that too, to encourage investment. Is there something there? What do you think?
I think it's a little bit of both. I think China is flexing because they do worry about companies, Alibaba, if Alibaba, it was at one point, it was close to $1 trillion market cap. I mean, if you get to 2 or 3 trillion, how much power do they have? Do they become too big to fail, right? Which is a major problem we have in the United States. And then the Chinese government has to handle them with these careful, gloved hands, just in, God forbid something happens and it crashes the whole economy. So I think that's part of it. And then I also think they're looking at it and say, hey, listen, we don't care what the rest of the world thinks. We're going to put these rules in place based on what we think is going to be the positives. And again, you could definitely argue about that, the libertarian side of, is it good or bad? And we don't want the government in our homes telling us what to do. But then at the same time, and by the way, I don't want the government telling me what to do, but at the same time, you do see, kids that just get so enthralled in video games when they could be learning, they could be outside. I mean, so I think most parents out there understand that there's kind of a fine line here. If parents step up and do their parenting, then you don't need that. But maybe China's saying, hey, listen, we see what's happening in the US. We want to kind of shift it away and at least try this angle. And again, there's so many views. It's such a touchy subject, right? Because like people get so upset about it. And all I can do is I just think logically, as a parent and as an investor and a stock trader, and I just kind of look at the different angles and I just try to think logically about it. So when the stocks were falling and collapsing, for me, I was like, okay, logic. Yes, it's fear and panic. And every day I would wake up and see Alibaba down another 5%. But it's like, okay, do they have a core business? Does China want to just put them out of business? Well, no. And yes, they have a core business. So I'm going to give it a shot. It's a calculated investment kind of scenario.
Interesting. Okay. I love that. Thanks for explaining that to me, Gareth. I appreciate it. Okay. Let's get back to where you see value right now. I asked this question. This is coming from personal interest. I'm seeking a home for some capital right now. I'm looking at commercial real estate in my hometown here in Squamish. I like the positions. I'm passively dollar cost averaging into a couple cryptocurrencies. I've got pretty overweight equities in the highly speculative, mainly precious metals and health science. That's kind of my bucket. My wife and I recently came into a new income stream. We're looking for a place to direct this cash, and I don't see anything right now, right? Maybe dry powder is the way to go then and hold cash. But what do you think? What are you looking at right now?
Yeah, so I think you're seeing it correctly in that it's very hard to find. I mean, there are so many bubbles out there. And in full and fair disclosure, so the last time I was living in Oregon, sold my house in Oregon, and I moved to Florida. Now, when I was going to move to Florida, I was looking at houses, right, and the prices were just ridiculous. And to me, some houses going for $100,000 over asking. I mean, just the ridiculousness of it. And I talked about it with my wife, and we're like, all right, we're going to rent. So we honestly, we got like a 1,400 square foot apartment, which is a little crazy because, we got 2 kids and 3 animals, but I'd much rather do that for 2 years and watch for a correction in real estate and then save myself a couple $100,000 at least, maybe more when we get some sort of pullback. So I think that's the angle I'm taking right now is I have a fair amount of cash sitting on the sidelines. I do have a fair exposure to gold right now. And I've been adding on dips because I think for the most part, that's kind of the safest place to hold money where, you're not going to get a 20, 30% crash in gold, but at the same time, it should kind of grind higher with the inflationary pressures out there. So that's a place. And then I think there are a few stocks out there. Like it's hard to find them, but like a stock like Viacom, where it's trading at a 9 to 10 forward PE, it pays a 2.5% dividend. It's got a great business that's been growing with their streaming. It could be a buyout candidate. There are small places. Now, again, you wouldn't want to put it all in Viacom or anything like that, but you just diversifying with a couple different areas, I think you could do. But the other side too is just keep some cash on the sidelines because you never know when a good opportunity will pop up, right?
Yeah, you're rarely going to regret that decision. People that hate on cash, but like, come on now. Yeah. You know what I mean? It also, and just on that, just to point out too, is people will say, oh, well, if there's 7% inflation, you're actually losing money. The answer is yes, you are. Absolutely. Yeah. But at the same time, why would you be in an asset that could drop 20% on you or 15%? It's better to do that. Or at least, you could always do, it's hard to find, you could at least get a few percentage points back by investing in some CDs or something like that over the next couple of years, but definitely keep it liquid, I would say. Yeah. And the angle with cash that I enjoy is that it gives you confidence. It gives me confidence. If I know I have some cash reserves, then I'm just comfortable taking risk over here, chasing down those highly speculative bets that tend to pay off in my experience, favorably, right? When you get them right. But without the cash reserve, similar, like 3 kids and a mortgage, I'm not taking those risks, right? I'm not doing that, right? So I need that insurance policy, that buffer. Why did you move from Oregon to Florida? Can I ask that? You don't have to answer.
Yeah. Oh, no worries. So for me, it's a couple fold, right? So number one, Oregon's beautiful. The summers are absolutely gorgeous. Low humidity, generally 80 degrees. Although this summer when I was there, we had like 115 degree days. Crazy with the climate crisis. And we have experienced in all fairness, a lot of smoke and fires, from California, the smoke coming up. But actually last summer, there were some fires that we were close to having to evacuate. So it's kind of gotten crazy in that respect. But the winters for us, and I was from Florida, that's where I met my wife. We're used to sun and everything like that. And the winters in Oregon are very dreary. Never gets that cold, like 40 degrees, but it's just that constant drizzle. You don't see the sun for weeks sometimes. And it can be depressing, frankly. So you have that, especially with my wife, that was a big factor. And then the other side was no state tax in Florida, right? No income tax. So in Oregon, I was paying 10%. And because I'm mobile, right? I can go to anywhere as long as I have a high speed internet. I can trade. I said to myself, well, we aren't enjoying the winters, so let's go to Florida, and then we save 10%. That 10% basically pays all our living expenses, essentially. So it was a good financial decision as well. But those were the main ones.
Interesting. Yeah. Okay. No sales tax in Oregon, though, correct?
True.
Yeah. It depends on what you're doing with your time.
And that is true. But what I did was, and this is an interesting one, if you're someone who lives like a crazy, lofty life, then that affects you. Like, to be honest, especially with 2 kids, it's not even like, and you have kids, like, it's not like you're going out to crazy parties and buying $500 bottles of this, or, I'm not buying a Lamborghini or anything. With 2 kids, I need like a family car. So I thought about that, and I'm like, listen, we don't even go to fancy restaurants with kids, right? We're going to like, these little kind of, small places that is pretty inexpensive. So that was one of the things too, is that the sales tax doesn't kill us, at least in that respect.
Yeah, I'm with you there. Okay. And I also live in the Pacific Northwest. I'm just north of you where you were in Squamish. Cool, I get it. The comment on the winters, they're long, they're tough. We tend to, we were developing a routine of spending a couple months abroad every winter, like November or February. Obviously that got turfed over the last 18 months, but we're looking forward to getting back to that this February. Okay, now I want to pull on a tweet that you posted. It was 5 days ago now, and I would just love you to elaborate on this for us, if you will, Gareth. So, prediction to be looked at in 10 years. The Federal Reserve will no longer exist. They will be the scapegoat of the next collapse, the worst this country has ever seen. the dollar will be digitized or changed and restrictions put into the system to not allow endless printing and debt. So if you could elaborate on that for us, that would be amazing.
Yeah, so this is something I've thought for quite a while, but it's clearly becoming a bigger issue, which is, again, you have the U.S. driving up debt more and more as spending is just increased, and the government is sending out checks, and just kind of the next thing is whether it's going to be a $3.5 trillion stimulus plan for infrastructure. And by the way, we need that. I mean, the U.S. needs an infrastructure deal, but at some point you have to say, okay, at what point are we going to see another major financial crisis? It is coming. And again, if you look at every financial crisis or every crisis we've had, probably for the last 20 or 30 years, everyone has been driven by the Federal Reserve. The Fed has created has a mandate. I think in 1977, they got the mandate where employment was additional to keeping inflation in check. And the problem with that is that employment, right? That basically means that the Fed has to make sure unemployment stays low and employment stays high. So the Fed is not supposed to allow unemployment to rise dramatically. Well, the problem with that is that it means that they cannot ever be hard-handed with the stock market, because if the stock market collapses, it's a chain reaction through the economy. And then you have unemployment go up, in which case, what do they have to do? They have to, do more QE to make sure the stock market goes up, which then heals the economy. And it's creating this massive, massive bubble. And if you look at 2008 and 2009, the financial crisis, it was really created by what the Fed put into effect after the dot-com bubble burst. So again, it's these policies that the Fed does that's trying to keep everything easy keel and just going steady forward and everything perfect. The problem is no economy is supposed to be like that. You have cycles, right? You have booms and busts and booms and busts. When you don't allow for the busts, what does it do? The balloon fills bigger and bigger and bigger with water until it just bursts. And that's the worry here, is that ultimately that's where we're headed, to some massive crisis where the Fed will be the scapegoat. The politicians will make sure of it, even though arguably they should be partially blamed too, but they'll put it on the Fed. I believe from the dust, you'll have a demand from the public that will say, we need rules in place where the government can't just endlessly run up debt, which, by the way, future generations have to repay. And you just can't have a Federal Reserve that's willing to just inject billions, trillions of dollars into the system. There will be restrictions. And I think that will breed some sort of digitized dollar that has restrictions. I've even dealt with the chance that you might have a mass kind of forgiving of debt around the world, because again, we know that we're not the only country with this issue. So you wonder if you'll just have this mass reset, and then from the depths of that will come this kind of new order when it comes to currencies. And I think crypto is kind of setting the table. I don't think Bitcoin is going to be that currency, but I think there will either be a US currency or it will be a kind of a joint world currency that will come from that, where maybe, the UK and Europe and the US and maybe Japan all join together. I don't know if China will join in there, but I do think that that's probably on the horizon. So yeah, it's such a crazy time. I do worry about my kids and what they're going to have to endure in the future, for sure. And by the way, with climate change too, all these things.
Sure. Yeah, there's definitely a lot of forces at play. In that scenario, Gareth, getting a bit more macro here, do you see the global power balance shifting? If an event like that were to occur in the world powerhouse, being the United States, how could that affect the geopolitical balance, the perception of power in the US? Any thoughts there?
Yeah. So one of the things is I do believe that China is on the verge, if not already, kind of the powerhouse out there. I think their digital yuan. So the China's always on the cutting edge, and it's I don't know if it's our politicians just not being able to agree or the Fed is just behind, but they've already launched the digital yuan, right? So my guess is that the digital yuan, the goal of China, whether this is Belt and Road or just another initiative, is that the digital yuan will replace the dollar as the reserve currency of the world. If that happens, it's going to add fuel to that collapse here, because countries around the world have to hold billions, if not trillions, in reserve currency to make transactions in dollars. Once that digital currency changes, they can dump all those dollars on the open market. There's no reason to hold them anymore. So my guess is that's kind of the direction things are going to go. A lot of people have said to me, hey, China has just as much debt, just as many problems. the answer is yes, that's true. There's a difference though. The US is a mature economy where our growth rate, right, is 1-2%, maybe 0% going forward. I mean, that's what the Fed is basically saying. Hey, let's hope we can keep it just positive. While China has a much more robust, consumer class emerging, a middle class emerging, which can help them kind of deal with these issues. I mean, they remind me of how the US was with the consumer in the 50s, if you will, after World War II. So anyways, I think that that's going to be a shakeup. I still think the US will be a big player out there, but certainly not the biggest. And by the way, if you look at reserve currencies throughout history, almost most reserve currencies don't last more than 100 years or so. And we're kind of right at that range right now.
Yeah. It's a fascinating conversation. It's one of the most frequent points of debate on my channel right now is, this idea that the US owned the 20th century. Who's going to own the 21st century? Will it be the US or will power shift to the East? And obviously there's no answer to that question. It's a wait and see. And it's, probably going to wait and see for the remainder of my life, a shift like that. But fascinating nonetheless. Okay, look, Gareth, it's been awesome having you back on the show. Just a quick hit. What can people find at inthemoneystocks.com? Why should they go and visit?
If you're interested in swing trades, in the money stocks, that's where I put out my live trades. So whether it's on Bitcoin swings or on stocks or ETFs or commodities, that's where I do it there under verified investing alerts on inthemoneystocks.com. And if you're just interested in kind of following my tweets and then I post charts and kind of market perspectives, follow me on Twitter at Gareth Soloway.
Okay, awesome, buddy. Once again, thanks for coming back on.
It's been a pleasure, Jay. Thanks for having me.
Okay, guys, 3 last things. First, if you enjoy my interviews and would like a bit more, you can subscribe to my Friday newsletter. It's free, and the comment to subscribe is right beneath this video in that pinned comment. In this newsletter, I share my key lessons learned, takeaways, and any actions that I might be taking in the market as a consequence of what I've learned on the show. Second, when I started a YouTube channel, I never anticipated generating any advertising revenue. But coincidentally, I do now, which is awesome. And so what I've decided to do is donate this to an organization that is very close to my heart called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by providing young people experiencing homelessness with supportive housing, employment, professional support, life skills, and outdoor adventure. Because often young people in urban centers with no resources will never get the opportunity to experience wild places, nature that can be so transformational and absolutely was for me. Third, if you prefer to listen to my content, you can now find us wherever you listen to podcasts. Just search for The Jay Martin Show.